The markets to a great deal have now started discounting weak set of corporate numbers expected to come through in Q1 of F16, followed by the weak set of numbers that we've just witnessed in the quarter gone by. Again, I think on the domestic front, what happens with monsoon and the first take by the end of June will be a deciding factor on how production estimate in terms of agricultural output happen and the associated industries related with that, FMCG, auto, will react accordingly. On the international side of things, what happens with Greece, and more or less it is now assumed that if the Fed hike has to happen, it will happen in September. So a lot of issues that were plaguing the markets, there is some amount of respite setting in, and again there is a lot of discounting that the markets have already started factoring in. Having said that, our take is that one should really adopt a stock-specific approach and look at long-term fundamentals of companies with strong balance sheets, where macroeconomic conditions in terms of capex outlay for the government, whether that be related to the power sector, infrastructure sectors, and again I think strong managements. These are the companies that one should ideally look out for. So companies with throw out a good amount of cash, where the free cash generation is quite strong and robust, is something that we'll suggest. Having said that, what was wrong to look at, I think the Nifty range can be between 8,000 to 8,500. Within this range, what we are liking is the private banking space. Axis Bank, Yes Bank, ICICI Bank is something we continue to prefer. LIC Housing on the housing finance front is something that we really like, considering the kind of spreads that the company will enjoy over the next few quarters, assuming interest rates coming down and incremental borrowing cost reducing over a period of time. Within the pharma space, Dr. Reddy's is something we are liking. The results were a mixed bag, but clearly with the kind of A&D applications that Dr. Reddy has got, it holds it in good stead and valuation again supportive of it. Large cap IT we continue to prefer over the next 4 quarters. So TCS, HCL Tech, Infosys is something that we continue to prefer to like. Within the mid-cap universe, auto ancillary stocks like JK Tyre in the tire space, something like a Subaru which caters to the air conditioning PV market, something like an MT Educare from the educational transformational space, and again something like a Surya Roshni or Bajaj Electrical from the LED consumer space is something we like. So have a stock-specific approach, go for stocks with strong management and corporate governance and cash flows, and clearly I think you should benefit over the next 12 months.